RSPs are a scam and you shouldn't use them, is what somebody said to me. So let's talk about why that's wrong. Okay. So first off, I understand why people would say that. So we'll talk about why they would say that.
I need the understanding.
Why do you think they would say that?
Because they think the government is out to get them.
I mean, that's beside the point. Okay.
Okay. It's one of those podcasts now. Conspiracy.
No. So a lot of people, and it's not a small amount of people.
Really?
Yeah.
What's going on out there?
Because financial literacy is very low. So what happens is people will contribute to RRSPs all of their life, and then they will go to take the money out, and then suddenly the government's taking 30%. Well, that's a scam.
Yeah, they're scamming me.
They're scamming me, yeah.
They made me put my money in here.
Yeah,
yeah,
exactly.
Yeah, I see.
Why is it not a scam?
Because all the rules are available to you. You didn't read the rule book. I know it sucks.
Basically,
I didn't read it either, to be honest. But
basically, it's a case of RRSPs are a tool, and I've already said this many times on the podcast, but RRSPs are a tool to move income from one year into another. Mm-hmm. That is all they are very, very good at. So, or how people should think about it anyway. So, when you are moving income from years when you're working, you get a tax refund often. Or think of it, don't even think about it as tax refund. You don't have to pay that tax on that dollar because you're moving that income to future years. But what do most people go do with their tax refund?
Spend it.
They go spend it, right?
Of course.
Or if you're self-employed, it's just less tax that you have to pay.
Yeah.
And then they will go and
spend it,
right? Not do anything with the tax that they should have paid, but didn't pay. Right?
Yeah.
So that means that they don't actually see the full benefit of an RRSP, because the benefit is that it's almost like you get to invest and save more because you are getting this tax. You're not paying this tax. Mm-hmm. But when people don't, that's when they don't save enough, and then they complain that, hey, my $1 million in my RRSP that I've religiously invested in is actually only $650,000, $700,000 right, at the end of the day because of all the tax and stuff like that.
Yeah.
Well, that upsets a lot of people.
I bet.
You need to plan better, right? Because when you are contributing to RRSPs, you have to think about the withdrawal side of that. And this is where, do I actually expect the average person to do this? No. But you have to then, well, you face the consequences either way. Government gets their money. But you have to, well, no, I'll challenge you. You have to not think about RRSPs as a tool to get a tax refund. If that is how you're viewing RRSPs, then you are likely heading for trouble, because that is not what RRSPs do.
Or some people just think of it as a type of savings account. Like, do they not? I feel like people would say that when I worked at...
Yeah, that's extremely low financial literacy. I'm not going to go there. Okay. But yeah, some people might.
It's like they don't understand all the benefits of the tool, or they just don't understand the tool they're using.
Yeah, they don't understand the tool they're using. They're told
mallet.
RRSPs.
They're using a mallet for a nail on a wall when it's like,
get around into issues.
Is that a good analogy?
It's good enough. I don't know. I'd use the screwdriver on a nail or something like that, but a mallet, it works.
I was thinking because it still kind of gets the job done. Like, you're saving money, you're investing, but you're using it inappropriately. So it's like you're going to end up with a hole in the wall potentially because you got a big mallet. And see how deep that was?
You've
I put a lot of thought very quickly.
Yeah. Okay, well, maybe that's the example we're going to use
that's
from now.
That's a great illustration.
The rest of this episode, that's the example we're using.
Mallet on the nail.
Yeah. But I ran into this recently with a client that they had 1 year left of retirement, of working until they retired. Of retirement.
I'm like,
this is when they died. Yikes. No, they had 1 year left of working, and it was a high income year.
Okay.
So they were earning It was about over $200,000, almost $200,000 in this year. And when we built the plan was to take a bunch of money, put it into the RRSP. It was like $40,000 or something like that. We're going to put it into the RRSP and then take it out the year afterwards, because again, you're moving income from one year into another year. Mm-hmm. My plan was to put it in there December 31st, practically speaking, and then take it out January 1st, right? So you're just moving income. Used to be in that year, now it's in this year.
Yeah.
And I got a ton of pushback from it, so much so that they actually didn't do it. They kind of like stopped replying. I was like, we got to do this before the deadline. Didn't do it. I found out later that's why, because they spoke to a friend or whatever, and it was that friend said that they shouldn't do it because RRSPs were a scam. And it was like, unfortunately for that individual, it cost them probably, I think I did the math, it was like $12,000 or something like that is what that cost them, right? Because they didn't understand how it worked. And there's people out there that say crazy things that they don't actually know what they're talking about.
But again, it's that whole like trusting your friend over any, because it's like, yeah, they may have good intentions, but they're not right all the time.
Yeah, that's what kind of led me to think about it a little bit more, because I know I'd heard it before, but it's been a very, very long time
since someone said that.
Somebody really said that to me, or it impacted me in any way, right? Because normally the people that would be saying that are not really the people that I'd be working with for the most part. It is a very low level of financial literacy. Yeah. So I wanted to talk about what it does, what RRSPs do, and the withdrawal process of them, because you have to understand the withdrawal side of it in order to understand how you should be using it as a tool. Mm-hmm. So the withdrawal side of it is very simple. It's a tax planning game. When it comes to RRSPs, as I said, you're moving income from one year into another. So you contribute to RRSPs, take income off of that year, and you simply take that income in a future year. And while it's in that account, you get to defer the taxes on any growth that money earns. Yeah. It's pretty simple. Just because you don't need to spend the money doesn't mean you don't earn the income. That's like me saying, hey boss, pay me less because I don't actually want to spend the money this year. Just keep it.
But you owe me later.
Yeah. It's like, who's going to do that? Nobody's realistically going to do that. They're going to say, give me the money, I'll take the money and I'll do something else with it. I'll save it. I'll invest it. I'll do something else with it. Doesn't mean it has to be spent. So when you're looking at retirement planning, you have to understand that there is two things that you are solving for. You're solving for the first thing, which is the most important, of course, is that do I have enough money to live the life that I want and put food on my table, and if markets drop, not have to worry and panic, and what's the plan going to be when markets do drop, and all of that stuff. You're looking at the feasibility of their retirement. The second thing is you're looking at the efficiency of their retirement. By efficiency, I mean tax efficiency of their retirement, which means that very seldom, very, very seldom is the right decision not to take income or have very, very low income in your early retirement years.
That's not the right decision?
That's almost never.
So you should take more income in the early years?
You should be taking income in those years. So what sometimes would happen is that teachers are a prime example of this, where they will retire and then they'll not work, so they get their pension and they've built up all these RRSPs. And let's say they retire at 55 years old and they've been pretty diligent. They have $350,000, $400,000 sitting in RRSPs, and they choose to not take any of it, right? Mm-hmm. Maybe some of these people, they don't have anything in TFSAs. They don't have a non-registered account. They don't have anything like that. But they don't need the money right now, so they'll delay it. Well, eventually time will pass and that $400,000 will grow. And now at 65 years old, that $400,000 is now $800,000.
Right.
And now their bridge benefit for their pension will drop off. And then they'll start taking old age security and CVP. Well, here's the thing about taking old age security. It's a income tested benefit, which means that your income, in order to receive it, needs to receive the full amount, needs to be below around $95,000-ish. But at 71 years old, this RRSP is turned into a RRIF, where you are now forced to take money out of it.
Yeah.
Well, now you're in a position where your RSP is now growing. If it was 800 at 65, it's now at 1.2, something like that, at 70 years old, and you're being forced to withdraw $60,000 from it every year. And that percentage is going up every single year. Well, on a $1.2 million portfolio, $60,000 isn't even the interest. So your portfolio is continuing to go up.
It's like, what? This is such a funny problem to have. I'm not going to lie. It's like, oh no, I'm getting too much money.
Right?
How do I spend this
And all this time, they still don't have maxed out TFSAs, still haven't done all of these things that that you should do. And then their partner passes away. And suddenly they now have double the pension. And all their partner's money is now also not being paid tax on yet.
By the way, if you're out there and you're like, oh, what am I doing with all this money? I'm just saying there's people out there who might want some. And you can find my contact info.
Yeah, if only it was that simple.
I know, right? They're like, I can't give it to you
because it's stuck in an RRSP or RRIF or whatever. Yeah.
Oh, that sounds hard.
Well, it creates this problem because they're seeing it as I might need it later, instead of, okay, this is money that I haven't paid tax on yet. I need to pay tax on it as efficiently as possible.
Yeah.
So that's why at 55 years old, if you're planning this out and you see this problem happening, you would start to take large amounts of this money out. You would start to max out your TFSAs. You would even start a non-registered account that is very tax efficient. You would do things because you do not want to be stuck in this position where you are basically forced to forego all these government benefits just so you can have low income between 55 and 71.
Which is like, is that, I guess
it's also your biggest spending years.
Yeah, in retirement, you're going to be traveling, doing stuff with your family.
Yeah, take it out, spend and it might not be to spend it, right? Depending on how much you have, but you should be taking it out to pay tax on it, especially starting before you have access to other government benefits that are income tested. Even the medical plans and those type of things and the drug coverages and stuff like that, all of that, most of that stuff is income tested. If I'm gonna,
oh yeah, that's true.
Yeah, if I'm gonna have low income, I would like it to be when I'm older and probably on a bunch of drugs, you know? Like, that's the reality of it. It's not going to be when...
They're like, you have so much money and you're super sick, so you're going to pay extra. Like, this is the worst.
Right? Or it happens where older ones will end up in care homes.
Yeah.
That is, again,
probably income tested. Yeah.
And now they're paying significantly more for what? Right? Just because you didn't want to pay tax. And it's not a case of... This is how could you have foreseen this? Some of this stuff is really obvious that it's going to happen, right? To a planner, put it into any terrible planning software and you just come to the same conclusion. You can do it in Excel, honestly. Do it in Excel.
You do love Excel.
I do love Excel, yeah. You can do it in Excel and you'd very quickly see, okay, this is going to become a problem. So you need to start thinking about it. But the point is that an RRSP is that tool. It is a tool used to move income from one year into another. So how do you withdraw from it? You withdraw from it in low income years. Those low income years might even be maternity leaves and stuff like that. You still have the ability to withdraw during those periods of time. In fact, if I was sitting there with no income, I would withdraw money. You can take it out within a couple at basically 20-ish% taxes. Well, that's really
I've
low.
never heard that before. I'm kind of like, sorry, my brain's still way back there on the maternity leave thing. I'm like, what?
You have low income.
Yeah, I would never have thought about that. And I wonder
in Canada, we get the benefits, right? So
I guess people might not think about that. But what if you're taking an extended maternity leave? Because I know some people.
Yeah. But then it depends on if you're because there's more to it. So if you're taking an extended one, it means you're going back to work. So you have all the.
But I mean, what if you're taking an extended one and you're not going back to work, but you don't know when you're going back?
Well, maybe. Is you talking about yourself now?
Who would do that?
I'm
just saying in general.
There is a small misconception that even with spouses, you can still take out the minimum. You can still take out your exemption, but in Canada, when you do have a spouse, your first $15,000. If you're not working, you get to do it with the spouse and everything. So it's not as great as just take money out for free, but you can certainly take it out for cheap.
Yeah.
You can certainly take it out.
I feel like, again, it is one of those things where it's like a planning thing. And I feel like a lot of people struggle with that, which makes sense because everybody uses money. Nobody reads all the rules. I mean, in general. Like, obviously, you're a specialist, so it's
no,
like
but I still don't read. Do you know how big the tax code is? It's huge.
You referenced some of it, at least.
Yeah, I read the stuff that is important to me. I went to a tax conference run by a law firm, like a tax law firm in town, and they were talking about some of the changes and stuff like that. And it's just like those people, they read all the rules. I don't read all the rules.
How was the conference?
It was really interesting.
Really? I was gonna... That is awesome. That is not what I expected. I was like, what? Those people read all the rules, and I'm just expecting like a room full of monotone people.
No, they were cracking jokes. It was obviously rehearsed. Yeah, they rehearsed them significantly, but they were
the jokes.
They must have, yeah. There's no way you can be a tax lawyer and interesting and funny.
They're like,
just...
but at the end, waiting for the crowd to laugh.
Yeah, basically.
That's like me. I love making people laugh though. I hope people laugh at me on the podcast.
Or sigh or groan.
Yeah. I'm like, my jokes aren't rehearsed, everyone.
That like we can tell. Yeah. What was I saying now?
Sorry, you went to a tax conference and it was interesting.
Oh yeah, but they read all the rules. I don't read the stuff that is relevant to me. A lot of the tax code is about compliance, right? It's about compliance to certain things. Like on the tax planning side, you're mainly looking ahead and optimizing for efficiency, right? And income efficiency. It's a little bit different on the corporate side, which there are changes likely coming to maybe we'll discuss them, the eligible dividend.
Ooh, the eligible dividend, everyone. I'm sure everyone's excited. Knows a lot.
You don't remember the nerd accounts?
Of course I remember the nerd accounts.
Yeah.
And the RDTOH.
Yeah, look at you go. Yeah.
Another high five for the podcast.
Yeah, well
My financial literacy has definitely increased.
Yeah.
Since having to we should count how many hours I've had to spend talking to you about financial things. See, maybe I could be a financial planner at this point.
Yeah, you can write the CFP. You never know.
Should I just try it? Should I just be like, I'm gonna throw my name in there and try to read?
Do it blind. I don't think they'll let you, but I'd be interested to know if you do how well you do.
I would love to like do a mock. Obviously, I'm not interested in getting like actually certified by any means, but I would love to see how much I know now because I've been mentored for a long time.
You'd know more than some people that take it. Anyway.
Yikes.
Yeah, that was basically really what I wanted to cover was just the fact that it's contributing to it. Sorry. Contributing to it, how you do it is you determine what your long-term tax bracket is going to be.
Well, that's what we were talking about. I was saying the long-term planning is very difficult for people, I find.
Some of it is even difficult for me to do. And I would say...
It's like, just simply figure out what your long-term tax bracket is going to be.
That part's not the hard part. The hard part is, well, that might be the hard part as well. But you can get a pretty good idea depending on what career you're in, right? Like, you know that a nurse is going to make roughly this amount. There's certain careers that are going to be, so for a nurse is a great example where nurses will flirt with the $115,000-ish tax bracket. Like,
it's not what
around that point.
Yeah.
So, and then when like their taxable income, so they'll earn more and then they'll contribute to pensions and things like that, and it'll bring it down to that ish. So you'd make RRSPs around that tax bracket, right? You'd want your taxable income to always be below that threshold. So you'd know, okay, that's the minimum I'm going to do, RRSP contribution I'd do. You'd take money from your non-registered account, your TFSA accounts, all of those to make those contributions and get it below that tax bracket threshold. Mm-hmm. That is how you should approach RRSP contributions. But here's the thing. With Canada, there is a lot of benefits that are income tested. So it does complicate it a little bit. So even in the middle of tax brackets, sometimes it can make sense to do like on the lower end. So between like $50,000 and $100,000, sometimes it can still make sense to do RRSP contributions to get things like the child tax credit, right? And things like that. There's plenty of other things that are based on your taxable income. So sometimes you'll do it just to get those. But there's not actually a good tax planning software out there that includes all of the benefit stuff.
Yeah, well, probably because they maybe change and stuff to add new benefit.
There's that, but the question is, why would you need it? So tax planning stuff tends to be focused on the upper end of the tax spectrum.
Yeah.
Tax filing software is about compliance to the tax code. So you're just filing your taxes. So that doesn't need it. So it's really, you would need like lower income financial planning software to do it. That's updated with those things.
It kind of does suck that the people who really need, like, if people were genuinely like in a lower income bracket and could benefit from something like that and were willing to, you know, like, I'm not saying like if they wanted to work towards knowledge and that kind of stuff, they were motivated to do that.
Yeah.
But there's nothing that exists for it. So it's like that sucks for them. Like,
yeah. So if there's like,
or people on like, well, we were just talking about like people on disability, people on, it's like there are benefits and there are things for them that they could be utilizing, but there's no financial planner that they can go to for these things.
Well, no. Well, you can go, like, you could get, but this is where the line blurs. So you can go get pro bono help and advice and things like that at some places. But realistically, you're going to have to pay somebody for them. And people in that income range tend not to want to pay for professional services, right? So they're also the most likely people to use like H&R Block for their tax filings or like stuff like that, because you kind of want the easiest thing possible. And truth be told, especially on the lower income side of things, there's very few people that operate in it. Like, even for me, I don't work with enough people in that area to know all of the ins and the outs for
it's like you
somebody
can't
would need
specialize
and all the benefits that are available to you. Like, I could find it, but think about the time. So if I'm going to charge somebody for my time, they really gonna pay me like $1,000, $2,000 to take the hours it's gonna take for me to go through the Government of Canada website. Like, there are like small calculations and stuff that you can look through, and there's a list of a bunch of the benefits, but they just add a new one. So Canada Grocery and Essentials benefit, right? So it's like there's quarterly payments and how much you could receive, and like, but again, it's income tested. So like, there's so many that,
you know what they should do though? They should really just like, if somebody is on certain benefits, they should really just have a way to be like, hey, if you're on these benefits, you're probably gonna also, because you're telling me like,
they kind of do. So like this one, for instance, is like the GST HST credit.
Okay.
Right. So like with one, but it changes every year, right? So with maximum income threshold for married or common law individuals with or without children. So in 2024, with 2 children, $66,000, right? So it might make sense that if you're close to that amount as a household, that you do RRSP contributions to get you below that, right? And then you get this extra amount of your credit, and it might make up for the fact that, but that's a fair amount of planning for somebody with a household income of $66,000 with 2 children
and for them to be like, oh, you know what I'm going to do? I'm going to contribute to my RRSP because I want to bump income into another year. Like, they're,
like,
it's just very unlikely, I guess.
Yeah, exactly.
Which is, it's too bad.
It's too bad, because these are the type of people that would benefit from that type of planning the most.
Yeah.
But unfortunately, there's just very few people out there. As in, I don't know any. I don't know anybody out there that specializes in working with individuals in this type of income.
Well, like you said,
family income range, because it's not profitable to do. Like,
that's the issue.
It's very difficult to build a business out of it.
Yeah.
Because they're not the people that look for help with it, unfortunately. But
yeah.
Yeah, but anyway, that's so RRSPs can be used for that type of thing as well, where you again just moving income from one year into another. So use that tool as you would. There's tons and tons of uses for a tool like that. But one of them, which is the biggest one, is retirement. But you got to figure out what drawing it out looks like as well. There's lots of people that will hit retirement and all they have is RRSPs. And it's like, okay, you have an issue that now we'll try to fix, but there's an issue here.
Yeah. Again, but it's like the name of the account is registered retirement. Yeah. So people just mindlessly
put money in there, and that's for, you could save for retirement pretty efficiently without using an RRSP at all, right? Like you don't actually need to use an RRSP to do it. Lots of people wouldn't. No, I wouldn't say lots of people wouldn't. There's plenty of people out there that don't have much in RRSPs that can retire just fine.
Yeah.
Right, because they have other income sources, etc. I still remember a teacher that one of my first clients, in fact, but I very early stopped any RRSP contributions, and I know that they got comments from because they discussed it with friends and stuff like that, and I held firm to it. I was like, no, I know what they are telling you. It is wrong. It is wrong. We're going to pick a non-registered account, investing in a non-registered account over RRSPs, because I know what your income is going to be later on. I know what your pension looks like. This money is much more valuable than just mindlessly putting it into RRSPs and building up a big RRSP balance. You don't spend enough for this to be worthwhile. Anyway, for different people, it can make a lot more sense to use them in certain ways than others, right? So we still use them, but definitely nowhere near maxed or what we could potentially put in them. But the money isn't necessarily for retirement, right? It was like a building wealth fund, and now we're talking about lots of other things like building cabins and buying cabins and stuff like that because they paid off their home, and guess what? We have the money to do it, right? And do it tax efficiently if we wanted to use debt, right? There's so much potential because of the way that we built it versus just mindlessly putting into RRSPs.
And having those mental, again, same about how I do it. It's like this money is for this.
Yeah.
Instead of here's all the money and I can I've really struggled with that, and I've really tried to work on it over the years, but I still notice I have this $100 bill and that is for this. Can't use another bill. It's going to be this bill. Why?
It's exactly how a lot of people think about it.
Why am I wired that way?
I don't know. I think humanity is in general. I think it takes a little bit of work to get out of that habit, if anything.
Yeah.
But
it's you don't want to lose track of it or something.
But anyway, so
RRSPs are RRSPs. Not a scam.
No, they're not. It is basic math. They are not a religion that you have to.
I don't believe in.
I don't believe in it. No, it's. RRSPs are what they are. It's basic math.
You can disagree with it, I guess, but not use it, whatever. But
you can not use it, but for it to be a scam is low financial literacy. It's it has to be used appropriately. And as you said, if you were smacking a nail with a mallet, you say this is a scam mallet, but it's
this mallet
this is a garbage
broke my wall.
Yeah, you was using it wrong. That's why it broke your wall. It's very good at what it's designed for.
What is a mallet for? I just said that because I know it's a big hammer.
I think it's they use it in woodworking to. I just have this picture in my mind of somebody building a staircase and having to use a mallet on a piece of wood where they don't want to damage the wood. Which is why
because it's rubber and to maybe move things.
Yeah, to move the whole piece of wood into this small area. So I think it's designed so it doesn't cause damage on
That makes sense. If you're fitting pieces together, it's this has to be super tight.
Yeah.
So I need pressure to push it together, but I don't want to wreck the wood.
You don't want to use a nail hammer that's gonna
dent
put a huge dent in the wood or something like that.
See, wrong tool.
Right, but the mallets are great for certain things, right? Man. Just like with RRSPs, it's just a tool. It's just a tool.
Yeah.
It's how you use it. That's what matters. So if you're in a position where you're this is a scam, it's probably you. It's probably you.
Go read the rule book.
Yeah. I mean,
read the user manual. That's what it should be. User manual for your mallet.
Yeah, and I think part of this issue is caused by not enough people that know better, not calling people out, but correcting them, because even as an advisor, sometimes I could definitely see where it's easier to just go with what the client wants to do.
Yeah, it's uncomfortable to be like, you're wrong.
Yeah, absolutely, right?
People don't like being
or
wrong.
to say to somebody, no, we could avoid taxes this year, because I've done that with clients even this past tax year, where it's a case of we could, like, yeah, of course we could put money into RRSPs here, but when are we going to take it out, right? Let's look at your timeline. There ain't no time for us to take this out without you paying more taxes on it. So you're going to pay the taxes this year, right? Like, it's, you have the ability to. It's not going to, like, you earned a bunch of side gig money, right? Like, it's, you got to pay some tax on it. We'll pay only this much taxes. We'll put RRSPs in to bring your taxable income down to here, but you got to pay taxes. When we could say, okay, well, we'll just put in an extra $40,000 and don't pay any taxes. Like, you're going to have to pay the tax sometime.
Yeah. I think people hope you just will never have to pay the tax.
That's not the way it works.
Maybe the tax code will change in 20 years and then I won't have to pay the tax.
There's only one way that I think the tax code is going to go, and that's to pay more taxes.
So pay it while it's cheap.
Pay it while it's cheap. Absolutely. Yeah. But even when somebody passes away, right? Because all of that income is now in that 1 year. So if you have, $500,000 sitting in your RRIF when you pass away and you have nobody to roll it over to, that's $500,000 of income in that year. That's a big tax bill that you're paying. It's like, well, I'm glad you got to put it in there at 30%, and now you're paying 49%.
Doesn't make sense.
Doesn't make sense. Yeah, it doesn't make sense. It's a tool. Use a tool appropriately. But anyway, that's where we'll leave it for that one.
Perfect.
See you in the next one.
Bye.
Bye.
Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Visa Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.